What's up guys, my name is Connor King with Resolute Capital. So recently I finished reading this book, Common Sense Investing by John Bogle, the founder of Vanguard. In this video, I will go over some of the things I learned and share my thoughts on the book. Let's get into it. If you're excited about this video, please like it and subscribe to our channel where I post 2 videos every week. Also, this video is for entertainment purposes only, and you should always consult a professional financial advisor before making any decisions with your money. All right guys, so first up, if you want to get this book for yourself, we'll leave a link in the description of this video. I would highly recommend getting it for yourself and reading it. But first, to summarize it as best I can, I'm just going to read the opening paragraph of the book. Successful investing is all about common sense. As Warren Buffett, the Oracle of Omaha, has said, it is simple, but it is not easy. Simple arithmetic suggests, and history confirms, that the winning strategy for investing in stocks is to own all of the nation's publicly held businesses at a very low cost. By doing so, you're guaranteed to capture almost the entire return that these businesses generate in the form of dividends and earnings growth. The best way to implement this strategy is indeed simple. Buy a fund that holds this all-market portfolio and hold it forever. Such a fund is called an index fund. The first thing I want to note in this book is in the very beginning, there's an opening parable that Warren Buffett created, and I would highly suggest that you get on Google and search the Gotrocks Family Parable, and this will really open your eyes to how complicated our world has made investing, and it will show you how simple it is and how easy it is to get big returns without doing any work. One of the main takeaways in this parable is that it talks about how everyone is always trying to beat everyone else in investing and do the best they possibly can. And in a sense, what they're doing is they're making things way more complicated, and they're taking a very easy game to win and turning it into a huge loss just because they can't exercise patience and self-control. Bogle has a whole chapter in this book about the importance of dividends and why you need to be reinvesting them, and he shares some staggering data to back this up. Since 1926, dividends have contributed to 4.2% of the overall 10% annual return of the S&P 500. So they're very important. To demonstrate just how big of a deal this is, if you invested $10,000 in 1926 to 2016, just with price appreciation only without dividends reinvested, your $10,000 would be worth $1.7 million. However, if you invested the same $10,000 from 1926 to 2016, but you did reinvest your dividends, with that and price appreciation, your $10,000 would be worth $59.1 million in 2016. So even this example is across the span of 90 years. It just goes to show you how important it is to reinvest your dividends because they contribute to a huge portion of the overall return each year. So it is definitely sold to me on reinvesting all my dividends. There's a whole chapter in the book focused on taxes and its implications. I'm not going to go into that, but I do suggest you read it. There's also another chapter on reversion to the mean. This basically means that all things pretty much will eventually revert back to the average. And so basically, in terms of investing, if there's an actively managed mutual fund that has been doing great, outperforming the market, basically just give it some time, and eventually over the long run, its returns will basically be average to the market, which just means that everything basically reverts back to the mean. And so you might as well just go ahead and invest with the mean to not have to worry about anything. So one other thing that really stuck out to me in this book was how much Bogle really talks against looking at past performance, which I knew, but he really hones in on how bad it is. And to do this, he gives an explanation of how most actively managed mutual funds, he goes over their lifespan. And when they start, the ones that start doing well, they start outperforming the market really big. And so therefore they attract a lot of new investors and they grow their assets to be a huge amount. And then he also talks about how the normal job cycle of a manager for these mutual funds is about 10 years. And so if you've got a fund that's outperforming for 10 years, odds are they're going to have a completely new management team the next 10 years. And that team is already going to have a ton of assets in their mutual fund. So they're not going to be near as motivated to make the fund do well because they're already getting huge commissions. And so with this explanation, He just talks about how you can't look at past performance because especially with these mutual funds, there's no telling what the future is going to hold because there's so many variables that affect them. Another thing that stuck out to me in the book was how much Bogle cautions that there's really no telling what the rate of return is going to be for the overall market in the next few decades. And so in the next decade, he thinks it's going to be about 6%. He has a good bit of data to back that up. But then also overall, from there on out, there's really just no telling. My personal conclusion after reading this book was that since I'm so young, it would definitely be the wisest thing for me to invest the majority of my assets into an S&P 500 index fund. That way, it'll just guarantee my portion of the return of the market. And it's basically, you're just betting on America as a whole, which is a pretty safe bet. On top of this, if America isn't doing well, then we have much bigger problems at hand. Also for me personally, I don't want to be spending all my time analyzing securities and deciding what to buy, when to sell it. It's in my best interest to just focus on growing our company's profits because then everything else will just fall into place. Thanks for watching this video. If you enjoyed it, please like it and subscribe to our channel where we post 2 videos every week. Also leave any comments you have down below for questions that you have and we'll get back to you. See you next time.